Assalamualaikum and hello everyone. Welcome to my channel. Today we're going to learn how to prepare the consolidated statement of financial position with complete consolidation adjustment involving intercompany transaction. And I'm using a question coming from an edited past exam question September 2011 from FAR300, which is actually suitable for the use in FAR320. My focus is on question 4. So let's look at question 4. You have the summarized statement of financial position of Lily Berhad and Rose Berhad as at 30th of June, year 11. For your information, 30th of June, year 11 is the reporting date. This is the date that the financial statement or the consolidation will be done, and we are going to prepare the consolidated statement of financial position. So this is the current financial year end, right? So and this is going to be the reporting date. You have two companies there, Lily and Rose. So let us see who is the parent, who is the subsidiary. So if you look at the details of the investment given in information number 1, details of Lily Berhad investment in Rose. So Lily is investing in Rose, and Lily is investing, if you look here, the first information, Lily is investing 480,000 ordinary shares, and this 480,000 is out of the one that is in the Rose Berhad ordinary shares. So if you look at what you have here, this is in terms of amount, but we need to know what is the unit. So if you see here, you would notice that the number of shares would also be 800,000, since no information is given regarding the fair value. So we assume the ordinary shares here is also having the number of 800,000. So if you do that, you would notice that for on the acquisition date here, this is the date of acquisition, the percentage held by the parent company would be 60%. 60%, because you take 480,000 divided with 800,000 ordinary shares. 800 ordinary shares, and that will give you 60%, and therefore the NCI is 20%. So if this is 60, so NCI would be 20%. This is the one of parent, right? So if that is the case, so Lily is the parent company or the holding company, subsidiary is the in our case here, subsidiary is Rose Berhad. So if this happen, what you need to do is you need to do a consolidated financial statement. Here we start with consolidated statement of financial position. You are going to combine the asset of the subsidiary and the liabilities of the subsidiary together with equity with the one of the parent. So the parent will be combining. So the first step to do is to combine the financial statement. So when you combine the financial statement, you do not need to wait until you acquire the other shares like preference shares or acquire debenture. As long as you have acquired the ordinary shares, there is already a control, and therefore there is a need for consolidation. So if you can see here, the date of acquisition was on 1st of July. Right, so there has been, after 2 years, only the consolidation is being done. So if you can see here, it was acquired on 1st of July, year 11, year 9, and after 2 years somewhere here, 30th of June, 30th of June, year 11. This is the date that you will consolidate, the consolidation date. This is the date that you acquire the company. So that is the date. So after 2 years, 1, 2. Right. So before we proceed further, let us just prepare the template to just do the combination or the of asset and liabilities of the subsidiary. Okay, if you can see here, what I have prepared next to this question is the blank format for the consolidated statement of financial position of Lily and its subsidiary. So what we're going to include here is we're going to include the asset except the investment. So investment in rows will not be included in our blank template because the investment in rows is the investment in the subsidiary, because this is going to be eliminated against the cost of investment, and that will be not reported. So it's a big no. So you're going to include account receivable, and of course after you have invested in your subsidiary, you may have goodwill or you may have bargain purchase. This will be included in the blank format. And the loan to rows, this is an intercompany transaction. If you notice, there are loan to and from the group members. So this will also not be recorded, and you will have to see that these are going to also be eliminated. And we need to check why is it being eliminated, due to either goods in transit or cash in transit. So loan will not be included. Bank balance, yes. For the ordinary shares, you are going to include, but just the one of parent only. So I put here P only. Same goes for the 10% cumulative preference shares. These are equity shares. So you are going to just include the one of parent. So if there are investment in the preference shares of the subsidiary, of course, you are going to also look at how much. But in our case here, there are no preference shares in subsidiary, so there are simply none. Then you are going to, so it will be included, but only parent, as I mentioned. Then you're going to include the general reserve, but you're going to put the group general reserve. Same goes for the retained profit, the group retained profit. So those items that I mentioned, I already put it here, so you can check the format that I have prepared here, the group general reserve. And then when you acquire 60%, as I mentioned earlier, 20% belongs to the non-controlling interest. So you need to include another item or another rule for the non-controlling interest somewhere in between reserve and before the non-current liability, because non-controlling interest is also the equity of the subsidiary company that does not belong to the parent. So these are the shares or the amount that belong to the other shareholders. So that is the non-controlling shareholder. Then you have your 8% debenture and 10% redeemable preference shares. This must be included, but you need to look at what is the portion of the parent in the ordinary, in the debentures and redeemable preference shares of the subsidiary. So you need to focus here and look at what is the percentage. So if you look at the bottom here, you would see that preference shares and debenture were being acquired. So we're going to check what is the percentage being acquired, but we're just going to prepare the format first. So we include that. So percentage being acquired, you can calculate later by taking this 25,000 and divide it by the preference shares, which is the redeemable preference shares in the subsidiary. Same goes for the debenture. You will take the 40,000 divided by the RM 100,000 debenture in the subsidiary, and you'll be able to get the percentage. But bear in mind there is no non-controlling interest for these two items of financial instruments because they are not shares. Okay, so loan from Lily will not be included, but accounts payable will be included. Of course, you're going to add the parent with the one of the subsidiary. That will be the same for most of the item. Bills payable and debenture interest payable. So all item assets and liabilities are being included with certain exception. Big no, as I said, to the investment in rows because being eliminated, and also no portion of the subsidiaries ordinary shares will be included, as well as if there is any preference shares will be included in the consolidated financial statement, because we are going to eliminate and only reporting the one of the parent. Okay, so like when we do that, we can now just put the figure that we have here, all the figure here, whatever that we have already decided to be here, we can put it here. So if you look at what you have, I'm going to open up this for a while. Okay, you can see that I've already put the figures here. So you're going to show the one of parent with the one of the subsidiary. So the same thing will be just added. This part is what is we call combine. We are going to combine the one of the parent with the subsidiary first without doing any elimination. We will be doing that later. You can see that I've already divided this into few columns. This first part is for the combine or the combination of parent and subsidiary. The second part is for the elimination of the intra-group transaction, as well as elimination if it is necessary for other items. And the third part is the group result, which will represent the consolidated statement of financial position, and with some reference here that I would like to have to explain things to you. So you just do this, right? You would see that there are, as I mentioned here, for the ordinary and 10% cumulative preference shares, it is just the one of parent, none of the subsidiary, because the subsidiaries ordinary shares will have been eliminated together also with the preference shares. So subsidiaries ordinary shares is being eliminated against the investment in ordinary shares. The subsidiaries preference shares is eliminated against investment in preference shares and non-controlling interest. We'll see that later. Then we have to work out the group retained profit, group general reserve, and non-controlling interest later. So this few things here in this colorful box will be done through our construction of schedule, which is doing the analysis of the group reserve and the non-controlling interest via using this computation schedule. Right. Now, the non-current liabilities will also be done the same. Okay, we just do the addition first without any consolidation adjustment. Just copy the items from the question without doing any adjustment yet. Just make sure that you take the correct order items that are supposed to be consolidated. Having done that, you are halfway through already with the consolidated statement of financial position. Now let us look at our items relating to preference shares. So after you have done the template or prepared the template, let us look at the additional information and deal with the consolidation adjustment. In the meantime, you can also prepare your schedule, which is your schedule to compute the group reserve and non-controlling interest, right? So I'm going to look at this item, right? Okay, let us look at this part here. Okay, we have already decided what is the percentage acquired in parent and what is percentage acquired in the subsidiary. Earlier we have done that. Remember, the parent and NCI was 60% and 40%. Now for the preference shares, it will be 25,000 divided by the number. So the number here, if it's 100,000, so the number is 100,000 here. The amount is 100,000, so the units of shares are also 100. So that will give you 25%. No NCI. For the debentures, it would be RM in the amount 40,000 divided by the amount. It is amount, not unit, the amount. So 100,000. And the date, you would notice that the date is not the same with the acquisition of ordinary shares. Here it is 40%, and again there is no non-controlling interest because the remaining belongs to the other preference shareholder, redeemable preference shareholder, and as well as the debenture holder. The one acquired by the parent is just 40% and 25% accordingly. Then you have your information that you have at the bottom there regarding the pre-acquisition reserve. So this is the information on pre-acquisition reserve balance. So both have balances, but here the balances is a negative balance, which means this is a retained loss brought forward. And for the general reserve, there is no balance. So this is the pre-acquisition balance on the date of acquisition. If you do that, you would notice it's better to show this. The retained profit on the date of acquisition, retained profit of S subsidiary is 20, which is a loss. The general reserve of subsidiary is nil. So that is the date of acquisition. On the date of acquisition, 1st of July, year 9. However, if you look at the reporting date, 30th of June, year 11, which is after 2 years. After 2 years, this is the current financial year end. You would notice that the retained profit has now become, can you check the statement here? Retained profit has become 125, the one of the subsidiary, and the general reserve is 50. And you can see that there are changes here. For the retained profit, it has increased by 145,000 because here is a negative figure loss. So now this is what you call post-acquisition reserve. So this portion is post-acquisition reserve. And for the general reserve, the increase is by 50,000. However, these post-acquisition reserve are yet not being adjusted. Okay, done with that. And the rest of the thing is the consolidation adjustment or the additional information that need to be taken into consideration before you can prepare your consolidated statement of financial position, right? So information number 1 is on fair value adjustment. We just need to identify first, then we'll be doing the adjustment. This is on fair value adjustment. How do I know? Because you are informed that on the date of acquisition, one of the equipment of Rose, that has a carrying value of 530,000. Yeah, it has a carrying value of this on 30th of June. So that has been now revalued to 720,000. So that was the first thing that you will notice, the fair value adjustment of the asset of the subsidiary. So here is where you see things better. The date of acquisition here. So on the date of acquisition, you are informed 1st of July year 9, remember? And on this date, the fair value of the asset is 720,000. So this is the information, and that was the case. And you are also informed that somewhere 30th of June year 11, the reporting date, this carrying value of the asset was 530,000. So this is at carrying value, cost minus the accumulated depreciation. And you need to find out what are the surplus here by comparing with the carrying amount here. So you need to find out what is the carrying amount so that you can find out what is the surplus. So we'll be doing that. The second one is on declaration of dividend. So dividend here, you are informed that the directors of Lily and Rose, meaning that both the subsidiary and the parent company, they are declaring the dividend. So if that is the case, what you need to understand is to check whether which situation apply. So you know, if you have learned, there are three situations that may come across. One is that where both holding and subsidiary have recorded. Second situation is that both have not recorded the dividends or the interest. The third one is that subsidiary has recorded but the parent has not. Here you are informed directors only decided to declare full year preference dividend. So this is actually situation 2, right? Situation 2, because both have not recorded, so you are going to record, right? We're going to be doing that. This is both H and S have not, so we're doing that. Just identify that first. This is on dividend. Number 4 is on intercompany accounts receivable balances, where you are informed that it includes some amount due from the group members. So the amount due from group members, if you look here, RM 20,000 are due from Rose, and that is an intercompany transaction because the transaction of the sale of goods are between group members. You are informed the amount due for inventories costing 6,500 was sent by Lily. Lily is the seller, Rose is the buyer. Identify who is the seller, who is the buyer. And that was sent here, only reach Rose by 2nd of July. So that is going to be a goods in transit. So there is going to be goods in transit, and these goods in transit will be the one that you are going to be recognizing in order to do the elimination of the intercompany account receivable and accounts payable. Right. Number 5 is check that was sent as a payment to the loan. Remember, I told you earlier that the loan should have been eliminated, and the reason we are talking about this loan here, in case you wonder which one, this loan 70, and this loan of 50,000 here. So there's the balances here. Okay, you would see that the 50 and 70, so that is the one that caused the difference. The difference of 20,000 due to a check that was sent, but it was only received by Lily after the reporting date. So the check was sent on 25th of June to settle the payment, but the payment was only cleared or received by 5th of July. So this is cash in transit. So the loan will be eliminated because it is an intercompany transaction, and therefore this will have to be you need to recognize the cash in transit in order to do the elimination of the loan to and from. Then number 6 is regarding bonus issue. So for bonus issue, okay, you are informed that Rose is the one that declared bonus issue 1 ordinary shares for every 20 out of the general reserve. So general reserve is the one to be utilized. Bear in mind, the general reserve has zero balance. If you look at here, it has a zero balance here. So general reserve here, if you check, there are no balance on the date of acquisition. So when you have bonus issue, you need to go and decide, or you should look at the question as well, whether the bonus issue, is it going to be out of pre-acquisition reserve, or is it out of post-acquisition reserve. So since there are no pre-acquisition reserve balance, so we are going to do the bonus issue out of the post-acquisition reserve. So we need to do that. Next is item number 7, where you have the information saying that Lily has not taken credit. Lily has not taken credit for the debenture interest from Rose. So meaning to say that Rose has already declared the debenture interest, which is income from subsidiary to the point of view of Lily. However, Lily has not taken credit. So the consolidation adjustment here will depend on how the dividends are being treated or how the interests are being treated. And when Rose declared debenture interest, Lily will have a share, because Lily acquired earlier, if you can still recall, Lily acquired 40%. So we need to go and take credit for Lily, but when we prepare the group statement of financial position, this must not be reported. So it must be eliminated, the intra-group debenture interest or intra-group dividends. And so this situation relates to situation 3, where subsidiary has recorded the debenture interest, situation 3, where subsidiary has recorded but holding has not. Okay, we'll be doing that. Next is the item related to inventories. You are informed that goods were purchased from Lily at an invoice price of 25% cost plus. Amount is still owing. So this is intercompany sale of inventories, and you need to go and remove the unrealized profit on the sale of inventory. So this is for you to go and check out what is the unrealized profit on unsold inventory. So you need to go and check, and you need to check, this one is based on markup. So we need to find and use the markup given here, this 25%, and find out what are the unrealized profits so that we can remove. At the same time, you need to also notice that the amount is still owing. So the amount that is still owing here is the one that you also need to cancel off between accounts payable and accounts receivable. So the goods were purchased on credit. By the end of the reporting date, the amount between group members are still owing to and from each other. So this will also need to be cancelled off. So you need to also do for this part, the blue one here, you need to do the elimination or the cancellation of the intra-group balance of what? Balance of account receivable and accounts payable. Number 9 is related to bills payable. So here you have bills payable of Rose that was drawn in favor of Lily, and therefore that was intercompany bills. So if you look, the amount of the bill is 12. So we are not going to go and eliminate that. What we are going to eliminate is the undiscounted bill. So for this one, you need to find out what is the undiscounted bill payable and bill receivable, and you need to go and eliminate that. Okay, we'll be doing the elimination and the consolidation adjustment in the next video. I'll see you when I will see you. Okay, this is the first part of the step-by-step illustration on how to prepare the consolidated statement of financial position. I'll see you in the next video. Assalamualaikum. I will see you there.